Hello, and welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark, and today is December 24th, 2020, and it is 5 p.m. Markets today, of course, traded thinly because no one was really trading. And then, of course, there are abbreviated trading hours in the U.S. markets. So that was, and plus, there's all this noise about, U.S. stimulus or relief packet that the Republicans and the Democrats finally agreed upon, that the president is now deciding to, have a last go of political theater with. But the financial markets have overall seemed to just shrug most of that off. I mean, I'm looking at the dashboard, and the dashboard is signaling risk on. The dollar and the U.S. 10-year are moving together, and they are both, put it this way, they've got more things showing resistance than showing support. So there's a lot of downward pressure on the dollar and the 10-year prices right now. Then there's gold, S&P, and crude oil, all of which are either trading flat or inflected earlier in the week. I see an inflection point in gold and in crude oil somewhere between end of day Tuesday, start of day Wednesday for both, which kind of corresponds with an inflection point in the dollar as well. Dollar and the 10-year. So the only one that really didn't participate in that inflection, or at least reflect the inflection, is the S&P 500, which honestly all week is just traded sideways. The which kind of segues into the trade book for this week. I'm not 100% sure when the last time was that I recorded an episode, but I do think at that time I was talking about getting whipsawed a little bit in the 10-year Treasury market. And I think I just resorted to, after closing out the position, I just committed to buying more stock. Which, I mean, right after that, I think I saw that sell-off, right? Which would have been end of week last week. So, yeah, saw the sell-off in stocks right after I bought a little, added to the portfolio. But that's fine. I was able to start trading around some of the more active commodities, because again, looking at gold and looking at crude oil, right? Both commodities, we see that inflection point. So there's volatility in those markets, there's movement. Meanwhile, I'm looking at the dollar, the 10-year, and the S&P, all of which this week have basically traded sideways. Okay, and that divergence in volatility, I guess, between the commodities and the I guess what you would consider like the financial assets, which would be the dollar, the 10-year, and U.S. equities. I was able to shift my attention in the trade book towards a more commodity focused trade this week. So now, of course, because markets are thin and honestly everyone's really busy with the holiday season and real life, real world stuff, not just like looking at lines and charts, jump up and down on your screen all day. I was not necessarily actively trading this week, but I was able to take a couple positions based on some, I don't want to say longer term trends, but I guess medium term trends that I have noticed in the commodity space. And again, a lot of that, I guess, is tied in around with the optimism around closing the books on 2020 and going into 2021 effectively with the coronavirus vaccine in hand. It's just now a matter of the logistics of vaccinating people, but there's more optimism going into 2021, or there is a lot of. So hope springs eternal going into 2021, and I think that's being reflected in financial markets. But there are also some macro fundamentals that are at play, which became a little bit clearer to me this week, and I'll touch on those a little bit later. But for now, let's just look at what's in the trade book. So in the trade book this week, I'm looking at gold and corn. Again, commodity plays, and I'm looking at these trades purely based off of the charts. Now, there are some macro fundamentals, or there are some macro narratives that line up with the trade, but as far as the timing on the trade, it's all based on the technical analysis. So I'll start with the shorter term trade. So the shorter term trade, or the trade with the shortest outlook, is the corn trade. And I'm looking at a corn futures contract expiring in March. Now, instead of just buying the corn contract outright, and then having to monitor the effect on the cash, because it would be an outright futures position, I decided to take the set it and forget it route, which instead of just buying or taking a futures position, I take options on the futures. And that's what I did with corn. So I was looking at my charts on corn, and the different time frames tend to show you different things, because the price, you can have a trend within a trend. But if I'm looking at my screen and I'm looking at a 1-day chart and it's trending higher, and then I look at a 1-week chart and it's trending higher, and then I look at a 1-month chart and it's trending higher, and I look out to a quarterly chart, 3 months, and it's still trending higher, I'm thinking there's momentum behind this trade. So, first of all, how have I not noticed for the last 3 months corn has just been trending higher? It's ridiculous. But anyway, caught my attention, and I jumped on the trade earlier this week. So what I ended up doing was, because again, it's one of those things where it's done a lot, even just having an outright futures position, I really wanted to participate in some of that upside momentum, but not necessarily knowing where the reversal point, or at least the pivot point, would be for that trend. I really didn't want to be in a position where I bought in at the top of the market and then was just exposed to all downside shortly thereafter. So what I did was, instead of just buying an outright call, I did a vertical. call spread, and bought the calls out to on the corn. I'll tell you in a second. I mean, typically when it comes to options, I trade short dated options, a week or so, 2 weeks maybe. But again, because I'm expecting over the next couple weeks, because this week we have Christmas, next week we've got New Year's, right after that, we're going into the runoffs in Georgia, and then we're right after that we've got inauguration, and you've got still we have the Trump lame duck administration and all that they can do in the interim to just hey. So I'm expecting a bit of volatility, or at least we have plenty of opportunity for volatility. And if not, then we have plenty of opportunity for the markets to ignore the maelstrom of news that's being thrown at it and just stick to its trend. So I decided to go out a little bit longer dated on these options compared to what I typically do. So on the corn options, for instance, I've been sitting on these for a couple days now, right? So it's Thursday. So I probably started trading these on Monday or Tuesday. These things still have like 29 days left to expiration. And the spread I ended up putting on was I bought a call at 440, and I sold one at 455. So we're looking at a decent spread. The options, the spread was fairly cheap, so my break even on this one is at, let's just call it 445.50. And as of the close of trading today, the market price was at 450.50. So these options are in the money. That's and again, I don't know where this thing is gonna peak out. So at most, my loss is capped at a fairly low price, and at best, the exposure on the spread, I think I'm looking at probably like a 200% risk to return ratio. So that's not bad on a trade that is basically just riding a momentum trade. It has all the momentum in the world, which I think, being that as a commodity being priced in dollars, that downward trend in the dollar is what has been influencing these soft commodities to trend higher. So this is what's happening in corn. I'm also going to keep an eye on soybeans and wheat because of the way that the relationship is with the United States and China, and the amount of supply and demand that those two countries bring to the markets for those commodities. Like, there is room for mismatch, geopolitical influences on the market, so there's room for these commodities to jump around. And if you're gonna trade them instead of just taking a position in them, but actually trade them, then I think that kind of volatility is beautiful. But if the market gets overwhelmed by the news, or all the news that's being thrown at it, and it just chooses to ignore it and then just follow a trend, then that's good too, because you just basically just play momentum trades. So honestly, it looks like if the momentum continues with corn, into next week's trading session, more than likely this thing is gonna break through the top of the through the top of the spread, the range. So, but I mean, that's good. If another opportunity comes up, I'll just close it out, deploy the capital somewhere else. But I mean, if not, just keep it on the books and collect whatever time value is left in it, as it just ticks away towards expiration. So that's the play on corn. That's what I'm looking at with corn. The other commodity that I have on the trade book is gold. So now gold in the short term, and by short term I mean intraday, sometimes intra-week, its correlation, or the strength of its correlation to the dollar, changes. It fluctuates. But overall, the dollar depreciating or appreciating over a medium term or a long term will tend to correlate to the opposite movement in commodities, gold being one of them. Now, there's this narrative, and it's a narrative amongst institutional investors. So big money investors, hedge funds, pension funds, family offices, the big money, the so-called smart money. And the narrative is calling for a short dollar. And at first, I wasn't 100% sure why there was such a strong and convinced call for a short dollar. Because my mindset was, if the outlook is not 100% positive for the global economy, then there should be added demand for liquidity. But central banks, including the Federal Reserve, have made sure that there is no shortage of liquidity. So there is no outsized demand for liquidity because there's so much of it. And so that whole idea behind worsening outlook equaling a flight to quality, you don't need to fly to quality. The quality is everywhere you are. The other side of that narrative, or another aspect to that narrative, is a more technical aspect. Or you know what? Not even technical, it's a more mechanical aspect. And the mechanics I'm referring to is with the dollar index. So when we look at the dollar index, we look at a basket or an average of the currencies of major U.S. trading partners. Now, it's a weighted average, so not every currency in the basket holds the same weight in determining the average. The currency with the highest weight or highest weighting is the euro. So typically what we see is moves in the euro correspond roughly with opposite moves in the dollar index. So euro goes up, by definition, the dollar index has to go down. And of late, there's just been, and of course corresponding with the sell-off in the dollar, we've seen euro appreciation. And again, back to the macro fundamental logic, I was asking myself, well, why, if the economic outlook in the Eurozone in particular is so much worse than it is in the United States, why are investors selling US dollars and buying euros? And then it occurred to me that, well, it only occurred to me when I heard on Bloomberg in passing, so I don't have full context for this, that there was some 2-year German interest rate that was yielding a negative rate. And that struck me as odd, because that means that interest rates out to 2 years are negative in Germany. That's what the market expectation is for growth going forward. You know, like you put on deposit of $100, and in 2 years you get less back, and you should be happy with just getting what you get back versus the risk of even more loss in the open market. That's ridiculous. And not only is it ridiculous, but that's outright deflationary. It's not even disinflationary anymore. That's outright deflationary. Market expectations are for prices to fall. And the expectation is for prices to start falling as soon as 2 years out. And the idea with deflation is that illiquid assets aren't priced higher, or they're depreciated, or their prices are lower, because the time it takes for you to find a buyer, the price would have fallen. Because that's what inflation is. The expectation and the continual realization of falling prices. The same way inflation is the expectation and the continual realization of rising prices. Which, by the way, hey, the Fed has had a hard time. The Bank of Japan has had a hard time. The European Central Bank has had a hard time. Even the Bank of England, Bank of Canada have all had hard times trying to generate inflation over the last 10 years. Which is why I'm a firm believer that most central banks, including the Federal Reserve, are stuck in liquidity traps. And liquidity traps are inherently disinflationary, and if you sit in them long enough, they become deflationary. Ask the good folks in Japan. But because deflation has the opposite effect of eroding away the value of your money over time that inflation does, and it actually increases the purchasing power of your money because prices are falling, investors are actually selling dollars, which, if held in cash form over time, depreciates because of inflation in the US, albeit very small, but inflation nonetheless, and are selling those dollars to buy euros, which, if they hold on indefinitely, will only the purchasing power will only increase as prices are expected to fall across the Eurozone. So that's the fundamental reallocation that's happening, is as deflationary expectations increase in Europe, regardless or irregardless of what's happening with the economic outlook, as long as the deflationary expectation remains, investors will shift their reserve holdings, their cash reserve holdings, away from dollars and towards euros, simply because by holding the liquidity in euros, they see their purchasing power increase over time through deflation. Similarly with the Japanese yen. So the euro is going to basically become another safe haven currency. That's what we're seeing. But that mechanical driver pushing the euro up and therefore the dollar down means that commodities like gold should see, or at least should have, more support than resistance if their pricing mechanism is being pushed lower, then their prices should be pushed higher. Which brings me to gold. So the actual trade in gold. I look across the board when I choose my my investments or my trades, actually, because this is not an investment. The term on this is so short that this is a trade. So when picking my trades, I look across the board, and what I try to do is get the most bang from my buck. I never want to exclude myself from another opportunity simply because I pursued one specific opportunity. And what I did was I looked at a long-term chart of gold, and by medium term, because it's only a year. So 1 year worth of data on gold. And I saw what is referred to as a bull flag setup, which, for those of you who are not familiar, you can always visit rtn.education, and you can find links to more information where you can educate yourself in technical analysis. But for those of you that are familiar, bull flag pattern is typically a setup that you see. You look for a breakout, and then you have your price moving higher, hence the bull part. And with the instruments that you can trade long and short, you also have your bear flag pattern, which is a bull flag pattern upside down. And typically you look for a breakout and prices extend lower. And you can also set your targets past breakout with a Fibonacci extension. Again, those of you who are familiar with Fibonacci extensions and how I use them, that's typically how I set my exit targets. So I typically look for chart patterns for entry and Fibonacci's for exits. But stumbled upon a bull flag pattern on gold about a week ago. Highlighted the downward channel and looking for the breakout. So that's looking at a year's worth of data. So from there, I zoomed in and started looking at it on a month's worth of data. And looking back at a month's data, I see, because again, a lot of times these prices are fractal. And what that means is that a pattern that you tend to see on a larger term time frame is made up of that same pattern repeating on much smaller time frames. So I look at a 1 year chart, looking back at 1 year's worth of data, and I see a bull flag pattern. But as I zoom in to quarterly data, monthly data, weekly data, daily data, hourly data, I will find that same pattern just repeating over and over and over and over again on smaller time frames. And those smaller time frames loop over and over and add up to medium term time frames, and they form the same pattern. And those medium term time frames loop and add up over and over again to form longer term time frames. So works in both directions. You can start big, zoom in, or start small, zoom out. In this case, started big, zoomed in, and I'm seeing that same pattern. And what I was able to do, looking at the bull flag pattern, I also chose to play this with options, more of a set it and forget it type of approach. So now this one I do intend to play a little bit longer because the time frame that I discovered the pattern on was a longer term time frame. So that being said, I knew that I was going to have to commit whatever capital I wanted to commit to this trade for a longer period. So I wanted to get the most bang for my buck because I had to commit the capital. So I looked at my options. I could go with a futures contract. I can go with an options in a futures contract. I can go with an ETF, or I can go with an option on an ETF. The option on the ETF worked best for me because I can utilize more leverage. The buy-in is lower, and because it's an options play, I know what my max risk is going into it. So these are long only option strategies. So I take that back. Because sometimes I do use verticals, in which case you do have to buy and sell. But the spreads are basically net long. So I'm either net long a call or net long the underlying with a vertical spread. Or in case of put verticals, again, I'm net long put or net long put vertical. And with gold, when I first saw the setup, market was at about 170, right where it is right now, actually, 176. And that was end of week last week. So I saw the setup. I looked at a longer dated option, which, typically I play my options within intra-week. This case, with my gold option, it also has 22 days on the books. Actually, the corn has 29, the gold has 22. And I put that position on earlier, and as soon as I put the position I established at the end of the week last week. Start of trading on Sunday. There's some news about something or the other. I think that's the whole thing where they announced that the Democrats and Republicans had finally agreed on something. So gold jumps overnight into the European session. But we get into trading on Monday morning, and it's down. So the position I established on Friday opened up, but it's an option on an equity, so it didn't start repricing until 9:30 New York, which by that point the underlying was already below where I ended the week last week, or the previous week, so the position opened and automatically repriced lower. Not a problem. So gold is bouncing around. It establishes a support level. Now, the move lower on gold was slow at first and then all at once. I made a snap call to put on a put vertical intra-week, which again was supposed to expire at the end of this trading week, which happened to be today instead of Friday. So lost a day on that one, but put on a put vertical. The day I put it on, the price on gold fell. Price on GLD fell with it. The put vertical went positive briefly, but then the price of gold started bouncing around, and then eventually we saw that inflection point in Tuesday into Wednesday, and from there the put vertical basically went out of the money and stayed out of the money. But it was intra-week. I caught it at a really good time, so the max loss on it was minimal. It was like $36 per contract, or per spread. So it wasn't like the risk was outrageous, but it was just an attempt to hedge just in case I was completely wrong with that long call on gold, and or at least just wrong in the interim. So that I closed that position out this morning, all right, and looking at a longer term chart again with the Fibonacci's and looking at what the price is typically demonstrated at previous support levels at this point, I was convinced that gold had put in a support or found a support level, and in conjunction with other commodities, i.e. corn, which was just trending higher, looking at the correlations across the commodity spectrum, and then again looking at the outlook on the dollar, decided to add to my long position on gold. So this time though, instead of just being outright long on a call, I decided to go with a call vertical, which again, all it does is just reduce the overall cost. And by reducing the cost, I reduce my maximum loss. This call spread, this vertical expires in 15 days. So a week before the call. And the idea is that to have a rolling strategy, whereas either a call or a call vertical is put on the front end in anticipation of one rolling off the back end. The idea is to maintain the exposure in gold, but manage the cost or the maximum loss, and also trade the exposure. So I can increase my exposure using short dated call verticals. I can offset or hedge my longer term position, my base position, by using put verticals. So I effectively maintain a longer dated long call option position, and around the market performance of gold, I trade call verticals and put verticals to either lever up the position when it's moving in my direction, or offset the pullback when it's pulling back. So that's why I said that with the approach that I'm looking at with this particular trade, the intention was always going to be to have capital basically tied up, committed in the trade. So I needed to find the exposure without overcommitting cash. And I found that the best way to do that is with the options positions on the ETF. And with the options positions, I know what my max exposure is going into the trade, and I can manage the cash in the portfolio a little bit better versus outright futures positions, which settle every day, and based on how volatile the contracts are, they're either putting cash on your books or just eating up your cash positions. So which is perfectly fine for shorter trades, but if you're just gonna sit on something for a while, you may not want to run the risk of and then having to find yourself in a weird position where you're trying to do calendar spreads to hedge and stuff. It can get touch and go with futures. But yeah, so that's the outlook for gold. And corn as per the trade book. And again, these are probably trades that, because I don't expect too much activity in the markets between Christmas and New Year's, next week these will probably be the only things that I keep on the books. Maybe if I see the need or if I see an opportunity to, I can add to the equity position, because again, the dashboard is flashing risk on, and the long-term macro picture is also flashing risk on, albeit from a mechanical standpoint, but it's flashing risk on. Shorting the dollar, shorting the 10-year, and going long gold, long stocks, and long oil, so. And I mean, we're already starting to see the price pick up at the gas pump, so that might just be a harbinger of more to come. So that's it, but I'll keep an eye on things, keep looking at the charts, and I mean, the thing that I like about technical analysis is that it doesn't necessarily matter what instrument you're interested in trading or most familiar with trading, most comfortable with trading. You can find an approach that best suits your temperament and the market that you want to trade, and you can build a strategy around that. So anyone interested in learning how to trade like a Wall Street professional, you can visit rtn.education. That's rtn.education, where you will find links to a number of resources. And on that note, if anyone has any questions, comments, or concerns, I can personally be reached at contact@runthenumbers.biz. That's contact@runthenumbers.biz. And until we talk again, happy trading. When in doubt, take profits. And don't forget to pay your taxes.